Morning, folks. It's Dave Burrows. I'm Chief Strategist and President here at Barometer Capital Management. I want to thank everybody for joining us today. We got a pile of stuff to talk about. It's been a busy week, but there's even more to come. Lots of macro data that we're going to get to sift through this week. And let's take a look at how markets are setting up. Just coming in, as we always do, I want to touch on sort of where things stand from a macro perspective. Across asset classes, we continue to be in a structural bull market, which we initiated in 2013 when we exceeded, 2013 when we exceeded the highs from 2000 in the Dow and the S&P. And since then, we've been working our way higher in fits and starts, much like the bull market that went on 18 years starting in 1981 and ended in 2000, or the bull market that started in 1951 and despite several pullbacks along the way, persisted until we got into the mid-1960s, 1966. So this, I think, can be best seen looking at it this way. This is these are monthly bars going back to 1982. You can see that the bull market through the 80s and 90s was persistently above this rising 200-week moving average, which we continue to be today. And if we walk our way through what happened in the period between 2000 and 2013, we were pretty consistently back and forth across that green line. And then we've stayed persistently above it since then. So I know there's lots of concerns about all of the things going on in the world. Markets are amazingly resilient. We have had a bear market in time and in price. And it may well be that we have seen the upshot. Now, can't say for sure. There can always be more data that comes that changes people's minds. But that being said, as we sit right now, we believe we continue to be in a structural bull market in stocks. In bonds, we believe that we saw a generational low in yields in 2020 at 40 basis points. We think we saw a significant reversal, much like we did in the late 1940s. And we think it's more likely that we work our way higher in fits and starts over the next number of years, which is going to make it very difficult for bond investors. People got very complacent during that period where we had a series of lower highs and lower lows in yields dating back to 1981. But for the first time, as we've talked about over the last many weeks, we've broken above all of the various long-term moving averages and long-term trend headed back to 1981 and have seen a significant reversal. We look at the TLT ETF off the highs, down 48% at the low point. We've had 4 weeks of a bounce. We did have a rally in the spring, which certainly provided some relief to equity markets, just as this bounce has provided some relief to equity markets. But it's continued to believe that the bonds are challenged. And in the most subtle way, you can see that the 150-week moving average and the 200-week moving average have joined the 50-week moving average in headed lower. So really long-term trends take a long time to shift. And we certainly have been seeing that taking place. So very, very tough year for Treasury investors, worst year going back to 1786. And if we look at the period when rates shifted the last time in the late 40s, early 50s, returns for bond investors were particularly weak for a decade. So if you were to look at 1951 to 1966, the 10-year Treasury averaged a return of 1.6% a year against inflation that was higher than that. So net negative returns over the course of a 15-year period. In that period, stocks, while there were some stumbles, had very, very good years. This was a reflating economy. And I think that it's very possible we continue to have this in front of us. So that remains to be seen. So equities continue to be attractive. Fixed income continues to be challenged. Certainly, we're going to have tactical moves either way. And as we've talked about, we saw a generational bottoming in commodity prices in 2020. And relative to stocks, they've started to outperform, but really it's only probably the beginning. It's likely to go on for a long time, as it has in the past when we got these reversals. And certainly that's something that we have been busy positioning for. If you look at the broad-based commodity ETF DBC, which is made up of energy, metals, steel, and so on, we got a nice reversal in 2020. We had a 4-month pullback. In fact, while the stock market was selling off from December until April, commodity prices continued to march higher. That's a sign of leadership, resiliency in the face of weakness. They certainly pulled back in the last 4 months of the sell-off in stocks, but have outperformed stocks since the market low, again, taking back sort of a leadership role. And as we've talked about, the reason that commodity bull markets go on a lot longer than you expect is because over the course of a bear market, capital spending is subdued, ultimately by boards protecting capital and the balance sheets of the companies they represent. And we have seen no pickup in capital spending at this point. And we know we have structural shortages across a whole range of commodities. When we look at real estate, the relative underperformance versus the S&P has been profound so far over the course of the year. The real estate REIT at the worst point down 32%. And if we take the real estate development companies, still down about 30% on the year, and relative price performance continues to weaken. Of course, this is an asset that is one of the assets most hurt by rising rates because the cost of money continues to elevate. And that's after 40 years of falling rates, revalued real estate almost on a hockey stick. Let's talk about currency. We talked about in October, the US dollar index, after putting in a series of higher highs and higher lows, all the way up until mid-October, put in a lower high, matched the lower high, and then a lower low. And since then has certainly pulled back to the 200-day moving average. It's trying to find some support here, but my guess is technically weakening, likely to break the 200-day moving average. And the combination of a weaker dollar and maybe a little bit weaker interest rates on the bonds sets up a more positive setup for stocks and for commodities. If we take a look at the long-term picture, when the US dollar starts to sell off, it can go on a long time. It was roughly 41% pullback starting in 2001. Happens to coincide with the rollover in tech stocks. And it went on until 2008. That was a 7-year bear market for the US dollar. And we certainly had a good sharp pullback 2017, 18, a 15% pullback. So far, we've seen about a 9% pullback. But this was a very strong initiating candle in this down move, something that's likely to be a little bit more persistent. So at Barometer, as I think most folks know, we are not strategic investors in that we are not going to have a set of asset allocations that are sort of come one, come all. We're very targeted. We think that our job is to do 3 basic things. One is to use the tools that we have, which are largely breadth-based, to identify sustainable, revaluing market leadership. Groups within the market that have a tailwind, where something structurally has changed and where the multiples or valuations can expand or contract for a long period of time. We don't need to be everywhere. We need to identify market leadership, and we can get good diversification without owning every group. Our second job is to recognize change, new leadership as it emerges, and old leadership as it recedes, so that we can adjust the portfolios on the fly, because I think our clients are expecting us to recognize change before it's obvious. In the absence of leadership, have a willingness to be on the sidelines. So we spent a good part of this year with cash positions. We spent a good part of this year avoiding groups like technology and communications and real estate. We're very willing to play defense, but our job is to be tactical. And sometimes that means being invested when it is unpopular. And certainly when we started putting money back to work, in October, this was a very unpopular stance. But things are slowly improving. We've used our tools, 3 main sets of tools. One is some macro tools that we use to try to identify areas within our investable universe that we're seeing net new inflows of capital. Where's money getting put to work? Where is there a tailwind? And those groups we would identify as market leadership. Secondary set of tools are some bottom-up tools that help us filter down through about 60,000 securities to try to identify those that have fundamental characteristics that are good getting better. We're not ever looking for broken getting fixed. We like to own things that are strong and getting stronger. The best companies in the world have the easiest time hiring employees. They have the lowest cost of capital to grow their business. It's hard to knock out number one. We want to see strong fundamental characteristics and technical price characteristics that would support that view. Where we can find securities that meet those tests in areas of the market where there's some clear market leadership, that's where our portfolio should live. Now, clearly the world changes. New factors come to bear. And the third and probably most important part of our process is a very disciplined selling strategy. We can't let little mistakes turn into big ones. Where managers get into trouble is they become too vested in the ideas that they have researched and spent their hard work identifying. But the reality is, in the course of a year, if you make 20 investments, 2 or 3 are going to work out way better than you expected. You want to stay in those as long as they continue to work. The ones that don't work should come out of the portfolio quickly and quietly. So 20, 2 or 3 will be way better than you thought. 7 or 8 will be pretty good, and a bunch aren't going to work. Our success is tied to our ability to carve out the ones that don't work without letting them hurt us too badly. So by using stop losses and following them along in behind market advances, ultimately we're able to stay in our winning positions. But when things stop working, they wind up triggering our stops. We wind up going to the sidelines. Now, we behave differently in different types of markets. Ideally, over the course of a cycle, when you get late in a decline, a few strong stocks will turn up first, often while the market continues to weaken. And then as time goes by, breadth, or the percentage of stocks performing well, will start to expand. Now, whether this is a market or a sector or a theme, these are the areas we want to focus in. They are showing resiliency in the face of weakness. In a healthy market over time, breadth will continue to expand. More and more stocks participate. There's no bear market that ever took place while breadth was expanding. When breadth at some point starts to contract, when a problem shows up, it isn't going to be the strongest securities that get hurt first. It's going to be the weaklings. Think about tech. In February of 2021, the weakest tech companies, those with no earnings, started selling off. Apple and Google and Netflix continued higher. All through the year in 2021, one by one, the weaker tech stocks sold off. Finally, in December of 2021 and January of 22, it started to get to the leaders, and the S&P started to sell off. And we've seen deterioration in breadth ever since. So, we're going to mention today, Apple continues to be sloppy in the face of a strengthening market. So even the strongest companies within tech having a difficult time, it's hard to get excited about being there. So in the beginning of October, our breadth-based models were still flashing caution. On October the 11th, percent of stocks and uptrends in the NYSE had reversed and started moving higher, giving us a green light to start putting on positions. When breadth is contracting, as it was in Canada and as it was in the rest of the world, and as it was in the US up to that point, we don't put on any new positions. We're fighting the tide. If 70% of return comes from getting the market right and getting your sector exposures right, if you're seeing deterioration in breadth at the market level or at the sector level or both, it makes no sense to be putting on new positions. Since then, we've seen a significant bump. Things started to get better at the beginning of October. We had a 14% rally in the Dow in the month of October. As we sit today, basically all of our indicators have been improving. The percentage of stocks in uptrends is expanding in the NYSE, expanding globally, expanding in Canada. Percent of stocks trading above their 50-day moving average, again this week, improved. Yesterday, a sloppy day, had almost no impact on these numbers. Percent of stocks making new highs versus new lows is expanding. And the percent of stocks, importantly, above the long-term 30-week or 150-day moving average continued to expand. So where there's always going to be things to worry about. This past couple of days, concern that pickup in COVID numbers were going to extend the length of a lockdown in China, thereby impacting global health. But the markets absorbed it. It was a one-day sell-off. Today, the market hung in very, very well against it. And some of the most economically sensitive groups were outperforming today. When we look across the globe, geographically, breadth is improving for the whole Asia-Pacific region, all of the US, almost all of Europe, Japan, the Middle East, really around the world. There are a few markets that are still showing some sloppiness, but this has been steadily improving since the beginning of October. Let's look at the S&P. This is a short-term chart, really having where the market turned higher in October, and you can see there's been a series of rallies and consolidations. Rallies, consolidation, rally, consolidation. But we're putting in higher highs and higher lows. Looking at a little bit longer term since the beginning of the year. This is the bear market, 27.4% sell-off to the worst point, and we've been rallying since then. Now, a couple of things stand out to people as being important to watch. This 200-day moving average, which has been declining, is what we've run into at this point. We're trading above the 50-day moving average, and the 50-day moving average is turning higher. You can see the trajectory of the 200-day moving average is flattening out. Lots of people are looking for the market to run into difficulty at this point of resistance. Well, let's look at things a different way. If we look at the equal weight S&P 500, where we take out the impact of those 5 or 6 very large, biggest cap stocks, which include largely tech and communications, we're trading above the 200-day moving average and have been above it now for about a week and a half. So that's important. The equal weight S&P 500 is outperforming the cap weighted or market cap weighted S&P. It's why we look at breadth. It's why we look at each constituent as being important as opposed to only the largest of large caps. They can be misleading. If we take a look at the Dow has been relatively outperforming since the end of 2021, and it continues since we rallied. We've seen rising relative strength as the market was making lows, continues to work its way higher. So that tells us the nature of the type of market we're in. When we look at the NASDAQ 100, heavily tech weighted, relative strength versus the S&P has continually been weakening right up until now. We're almost at a relative strength new low versus the S&P 500. It tells you despite the bounce in tech, it's been ineffective at gaining any ground. In fact, continues to give ground against the rest of the market. But where have people put money? Flows all year long have been into large cap tech, where investors have said, here's my opportunity to buy these companies, these great companies inexpensively. But keep in mind how many investors are underwater. Virtually anybody who's been a buyer going back to October of 2020. So a lot of unhappy investors, a lot of them just like their money back. When we look at underneath the surface, new 52-week highs versus new 52-week lows, this is since the beginning of the year. There have been almost no days where there were more new highs than new lows. And while that's improving, we need to see this improve significantly for it to become a more interesting part of the market. Let's look at volatility. Volatility spiked in 2020 with the COVID onset. We've had several spikes since, but over the last few weeks, volatility is slowly dripping out of the market. In fact, we're back at a moving average of volatility that dates back several years. Volatility is normalizing. That's a positive. Now let's talk about leadership. At the beginning of October, almost every sector here in small letters was showing deteriorating breadth. On a distribution chart based on the percentage of stocks in uptrends, you can see all of the sectors were stacked up here on the left with a very low percentage of stocks in uptrends. The first groups that turned higher, however, were energy, transports, builders, oil service, Wall Street, machinery, steel, apparel, chemicals, precious metals. These are all reflationary sectors. Now, these are the sectors that held in best on the way down and were the first ones to turn higher. Let's fast forward to today. You can see that the market, almost every sector is showing expanding breadth. We're all large caps. We do show, though, a couple of groups have turned down recently. Semis. We've seen a little bit of weakness in some oil companies at the lower end, but oil service remains strong, as do industrials and basic materials. So let's run through the leadership. Energy continues to relatively outperform the US stock market. We traded on to new highs. We've consolidated over the past week. It continues to be very strong. We look at the Canadian similar universe of oil and gas producers, almost straight sideways here over the last week and a half as we consolidate near the highs. Relative price strength has continued to improve since late 2021. We talked a lot about the fact that energy, the XLE versus the S&P 500, has been strengthening on a relative basis and has reversed the trend that's been in place going back to 2008. It's really important because energy has been as high as 20% of the S&P in the past. Today makes up only 5%. Many investors not here in this place. Now, something that's had people scratching their heads is the fact that crude oil, West Texas crude, has been backing off since June. And it's come down a fair ways. In fact, this week, the near-term contract made a new lower low as of yesterday than it made in September. Yet energy shares continue to perform well. Why is that? Well, first of all, historically, there have been long periods of time where short-term movement in oil was less important to energy producers as investors were looking out beyond the near-term contract to what the pricing was for next year and the following year, and the likelihood that new supply would come on. We can see that really clearly on this chart. The spot price made a new low yesterday, where if we look at the 24-month out contract, making a significantly higher low. So what this is telling you is that oil investors do not believe that near-term extra supply, most likely caused by a pipeline outage in the US, is going to persist. And as a result, energy shares are outperforming the price of oil. Also keeping in mind, and I apologize for the blurriness of this chart, this is the seasonality of oil. And we know that historically over time, we tend to get a low in energy prices at the end of November, beginning of December. And here we are right in that spot. So for probably two reasons, energy shares continue to act well, especially given that the fact that the inventories are exceedingly low and the strategic reserve in the US has been continually drained over the last number of months by the Biden government trying to keep gasoline prices low. This can't go on. Oil service companies, after having a very nice rally, putting in a low in June, a higher low in September, and rallying back to make new highs almost immediately, have consolidated over the last 2 weeks. In fact, it sets up almost a perfect cup and handle technical formation. Should we come out of that handle, likely the measurement is substantially higher, maybe as much as $100. Let's move on from energy. Financials have been a secondary leadership group. Relative strength continues to improve. We have the XLF, which is the broad-based spider holding financial services companies, trading above the 200-day moving average, well above, and holding, again, against a weaker market over the last couple of days. The stronger ETF in the group are the capital markets ETF, IAI, and this is made up of companies like Goldman Sachs, JP Morgan, Raymond James, and LPL Financial. This is the best performing part of the financial sector. When you have energy with rising relative strength and financials with rising relative strength, this does not point to some kind of disinflationary crisis. It points to an economy that might be a little bit more resilient than people think. When we look at the large banks ETF, going back to 2008, after coming out of a bear market, we've consolidated and turned higher. I think this is the beginning of a new bull market in financial services. When we looked last week at some of the large cap banks, we talked a little bit about JP Morgan, where instead of breaking out to a new high in 2021, made it its first new high in 2015. If we look at RBC, one of our very large holdings at Barometer, we see the sell-off in 2008-9. In fact, recaptured almost immediately in 2010 and has been moving its way higher since then. We've seen strong relative strength versus the S&P since midway through 2021, trading better than 84% of companies in the S&P. Insurance also continued to make relative strength gains. So these leadership groups have been very persistent, leading into the market lows and on a relative basis, leading on the other side. Let's move to financials, another economically sensitive group. Relative strength for industrials turned higher in March and have been working their way higher ever since. Now, initially, the strength was coming from the defense sector. And we've talked lots about the companies here that we're focused in: General Dynamics, Northrop Grumman, Lockheed Martin. Obvious reasons that there would be strong demand. We've also talked about the equipment companies like Caterpillar and Cummins Diesel and John Deere. We mentioned CP Rail continued higher this week to make, again, new highs. Relative strength working its way higher all through the course of the year. This probably speaks well to export levels, especially in the commodity area where CP has a dominant share. But going beyond those companies we've talked about before, I wanted to touch on a few more. Transforce, TFII International, which recently bought the ground operations of UPS and is effectively turning that around. We're very close to making new all-time highs. Bombardier, a company that's gone through a major transformation and today really is just purely focused in business jets and making great progress. And of course, from the lows in October at $24, has roughly doubled over the course of the last 8 weeks. And Finning Equipment falling into the same camp as Caterpillar. This is the distributor for Caterpillar equipment in Canada and large parts of South America. Another position that's moved sharply higher since the market lows, $23 to $33. That's a 50% move today at a new high going back to May. So lots of groups, lots of companies within this group with strong fundamental characteristics, strong technical characteristics, all of them economically sensitive, and all of them significantly outperforming the market. Reflationary sectors. Let's talk quickly about mining. We're not going to focus on too many companies today, but this is a large bear market that the mining sector came out of. It goes back to 2014. In fact, really, it began in 2008. This is 2011 through 14. We made a low in 2015, a higher low in 2020. We broke out and pulled back, and these have started to march higher nicely. Nice relative strength improvement. If we take a look at the steel ETF, it looks very, very similar. We talked last week about Steel Dynamics and Nucor. This group acting very, very well. Again, not pointing to some kind of disinflationary or deflationary bust. The pricing remains resilient. So let's move to the dividend theme. We've talked all year about the fact that when we have rising interest rates, investors are going to look for a rising stream of dividends. If we combine the themes, rising dividends from sectors that are leading the market, which include energy and basic materials, we find this ETF really stands out. GUNR is a great example of a position where an investor can pay in one trade for a basket of the largest upstream resource producers in the world, in many cases, significant cash flow generators. The GUNR is paying a 4.4% dividend yield. It grew its dividend over the last year by 25%. And while I'm not sure we're going to see 25% dividend growth, we're going to see probably 15 anyway going forward. And this is one that could perform really, really well. It's got a great technical base setup with leadership coming from the sector. Healthcare. So we've had one end of the barbell, which is economically sensitive. The other end of the barbell in our portfolio approach has been defensive sectors, those that are unlikely to be hurt in the event that the economy does slow down. They're led by healthcare. A lot of companies paying great dividend streams here, rising relative strength since the end of 2021. Biotech has been one of the leadership groups, and certainly pharma has as well. We've talked a lot about some of the pharma holdings, but I think it's extraordinary what we're seeing going on in Merck. Merck has just absolutely blasted off a number of these companies coming with new novel treatments that really actually move the needle from an earnings perspective. Consumer staples in the defensive camp also continues to outperform. And of course, infrastructure and infrastructure suppliers. and builders doing particularly well. So the dividend theme is relatively continuing to outperform. FDL is an ETF made up of companies that have had historical ability to raise their dividends. This has got a 3.6% dividend yield. It'll grow its dividend about 10% a year. Looks like going forward, really attractive in a rising rate environment. We talked about Gunner already, and value as the theme continues to relatively outperform. So what is it that's not outperforming? Tech continues to be weak. IGM, Tech Select ETF, Microsoft, Apple, Google, Meta, Visa, MasterCard. These are all companies that we owned for a long period of time. But when things go out of favor, they can go out of favor for a long time. And despite the fact we've seen a great bounce in the market, we're trading almost at relative new lows. When we look at the communications sector, it continues to be very weak. And when we look at the growth theme as a whole, VUG, which is large cap growth, relative strength, new lows. I think it's actually really important to recognize that the largest cap companies in the market are really holding things back. This is relative price performance of Apple. This is a very toppy formation. And I know they got great products, and I know they've got a great diversified line of services that they're selling. But the fact is, it's probably owned by almost anybody who would want to own it. Okay, what is changing for the better is consumer discretionary. We've actually added some consumer discretionary positions over the last few weeks. We talked a little bit about the auto parts companies like Uniselect and Orly. I've shown in this chart relative strength versus the S&P starting to pick up. And importantly, relative strength of consumer discretionary versus consumer staples. So this week, we got some data out of the Black Friday sales. Numbers came in better than expected. Certainly, we may be dragging some sales forward from Christmas, but so far, the rumors of the consumer's death are greatly exaggerated. They continue to act well, but this is have and have nots in the right places in consumer discretionary. 70% of the US economy, some companies are doing quite well. One of the areas is the home building products or renovation products, and that partly is because margins have been particularly strong. Okay, so sector-wise, we're seeing outperformance in reflationary sectors. So that would make sense that the TSX continues to outperform the S&P. TSX is now trading above a rising 50-day moving average, a rising 21-day moving average, a flattening out 200-day moving average, and 150-day moving average. Good outperformance. Likely has to do with the fact that there's strong exposure in the TSX to the sectors that are leading, financials, materials, and industrials, and a lower weight in technology. So let's sum it up. Continues to be that we have a significant overweight position in energy. You can see we took the weight down by about 5% over the course of the last week, not because we think that the group is in difficulty, but when our breadth model turns down, we reduce our exposure. It's a rule, it's a process, it's our job. We have to be disciplined about that. Financials have grown in the portfolio now 15% versus an 11% weight in the S&P. Industrials close to 15% or twice the index weight. Materials continues to become a bigger part of the portfolio as the market continues to heal and show us strength in these groups. Steel and miners and agriculture continues to act well. Healthcare is an underweight, but significant weight at 8%. When we go down to the defensive sectors, consumer staples, sort of a market weight. Communication services, we do have some exposure to T-Mobile, which has acted better than the group, which is being held down by Meta and Google. Technology continues to be a very small weight. Consumer discretionary is slightly larger at 4.5%, but still a significant underweight because it does have risk from a weakening economy. We have some cash and short-term bonds, and then almost no weight in utilities and real estate. Outside of the US, we're continuing to see improvement in Japan. This is a market that is so far out of favor. It was in a bear market from 1991 until the present, and only recently starting to work its way out at that base. It's an odd market because the Japanese central bank owns virtually all of the Japanese bond market and many of the Japanese companies, but it's got to start somewhere. We're seeing relative improvement in India, and we're seeing improvement in Mexico. Now, all of this is happening against positioning in the market. And I said last week when we looked at the sentiment data, I recognize why it is that people are very cautious. In fact, if we look at the AAII data, bullish sentiment hit an extreme low over the recent few weeks, and bearish sentiment hit an extreme high. Sentiment is very washed out. When we look at the sectors that have the hedge fund exposures, very low exposures to stocks. We talked about the fact that almost every asset class is negative on the year, extremely unusual. We have to go back to 2018 to have even small negatives, but nothing like this. We recognize that around the world, almost every global country has had a difficult year in returns. And we've talked about the fact that when you have a very difficult 9-month period like we did this year coming into the end of September, the data tends to get better going forward. Well, here's a couple of other data points. Margin debt, or the amount that people are betting on leverage on stocks, is approaching the level we were at in 2009 and 2001 when the market bottomed. So this can move lower, but it's hard to see how investors are out over their skis. And when we look at put-call ratios, they're off the charts. In the week of November 23rd, we broke all records for the amount of put buying versus the amount of call buying. Put buying, of course, being options to put or sell a security at a fixed price in the future, is used to hedge a portfolio if an investor thinks there's a major problem coming. But this kind of consensus is contrarian. So low margin debt and high put buying means that investors have positioned for the worst. What happens if things continue to slowly get better? What happens if the market is looking beyond this Fed cycle, looking towards the likelihood that the Chinese are going to have to start relaxing their COVID policies? What will happen next? Well, we know in basic materials and energy, inventory levels are exceedingly low to begin with. And if you add additional demand, it's going to have an impact on price. Now, we have a big week coming up, a lot of macro data. Over the next few days, we get ADP employment data, third quarter GDP, personal consumption, the JOLTS job openings data, the number of jobs that are unfilled. Challenger job cuts for November is a very real-time number. Personal income, jobless claims, continuing claims, ISM manufacturing data, non-farm payrolls, and unemployment data. So there's a lot of things to look towards. What I'll be looking towards is not so much what the data is, but how the market reacts to the data. So we're going to watch things as they move forward. We continue to believe we're in a bull market in stocks and the very, very early stages of a long bull market in commodity prices. If our models should turn lower, if the data has a bigger impact than we expect, we'll get more defensive. But I always like to say markets react in a way that they are set up to react coming into an event. If the market is on a good footing and breadth is improving, often it can absorb bad news well. If in fact breadth starts to weaken, you can see a market react very poorly to bad news and sometimes even good news. So we'll continue to put one foot in front of the other. We'll continue to try and look for change. As we sit right now, we think coming in to Christmas, where we often have a decent December, markets are set up quite well, and we're happy with the positioning. And with that, I'm going to take a look and see if I've got any questions. We got lots of folks on today, and I don't have Pamela here to do a polling for questions. Let me just take a quick look. I actually see no questions and no chat. So with that, thanks everyone for joining us. We'll be back here next Tuesday. If anything should happen in the meantime that really requires comment, we'll put something out on Twitter. If you'd like to have a conversation, don't hesitate to reach out to us. We'll answer any questions that you have. And thanks very much for tuning in. We'll see you again next week.